All right, so today we're going to break down a really interesting investment analysis from the YouTube channel Financial Education. They've laid out the bull case for 5 different companies, looking ahead to 2026. And look, these aren't just random stock picks. No, they're stories. We're talking turnarounds, major market disruptions, and, maybe some hidden value the market is missing. So let's just dive right in.
Okay, so here's the plan. First up, a dominant brand that's supposedly at a discount. Then we've got an energy drink that's totally shaking things up. After that, an AI chip powerhouse. Then a Gen Z beauty brand that's just everywhere. And to wrap it all up, a fintech giant that, for some reason, everybody seems to hate.
All right, let's kick things off with number one, Nike. The argument here isn't just that, Nike's a great company. We all know that. The real thesis is that you can get this incredible company at what the source is calling a generational bargain. If you're a real athlete, you wear Nike. I mean, this quote really gets to the heart of Nike's power, right? The whole idea is that Nike has basically become synonymous with winning. They're not just sponsoring a few big names like Caitlin Clark, they sponsor entire leagues, so their logo is just everywhere. Even if an athlete doesn't have a direct deal with them, chances are they're still wearing Nike gear on the field. It creates this powerful subconscious link in our minds between Nike and being the best. But here's the crazy part. Despite all that brand power, the stock is trading at 50% off its highs. I mean, 50%. That's a massive discount. It's brought the company's valuation all the way back to where it was in 2015, 2016. Think about that for a second. The point they're making is you're getting the much, much bigger business of today for a price from nearly a decade ago. So you're probably asking, why the huge discount? Well, the source points a finger directly at past leadership. See, the old CEO came from consulting and just consistently missed earnings, missed revenue. It created a lot of doubt. But that was then. The story now is all about the turnaround. The new CEO, Elliott Hill, has been on the job for over a year, and he's got a track record of consistently beating revenue estimates. And that, according to this thesis, is what's bringing investors back. And this isn't just a story. You can see the proof right here in the numbers. I mean, just a few quarters back, revenue was actually shrinking by 12%. Now it's flipped back to positive growth. It looks like operating income and margins have finally bottomed out and are starting to climb again. And then you throw in the fact that the super important China market is expected to get back to growth later in 2026. Well, the argument is that the business has officially turned a corner. Okay, let's move on to our second company, Celsius. Now, this is a fascinating story. It's all about a brand that absolutely exploded onto the scene by going after a group of customers that its biggest competitors, well, they just totally ignored them. The whole insight here is just genius-level strategy. Think about it. Red Bull, Monster, they were all about extreme sports, the party scene, a really male-focused audience. Celsius did a total pivot. They went straight for the fitness community, people at the gym. And here's the real game changer. With their Alani brand, they successfully tapped into a huge female demographic. That's a market that, according to the source, the big energy drink companies had basically written off for years. And wow, that strategy translates into some seriously aggressive growth projections. The source's base case, like their standard expectation, is for 19% compound annual growth over the next 4 years. The bull case, that jumps to 30%. And get this, some other models they looked at are projecting as high as 60%. The key takeaway here is that even in their most conservative scenario, they're expecting this company to deliver returns that crush the overall market. Okay, for our third company, we're diving into a tech giant you definitely know, AMD. But listen, this investment thesis isn't about its past successes. No, it all boils down to a single product that the source is calling the most important in the company's entire history. To really get what a wild ride this company's been on, we have to start right here. $1.91. That's not a typo. That was the stock price not long after the current CEO, Lisa Su, took the reins. It was a pretty bleak picture. And let's be totally clear about this, the perception back then, as the source points out, wasn't just that they were struggling. People thought the company was headed straight for bankruptcy. It was seen as a dying business, period. Okay, now, fast forward to today. Under that exact same CEO, AMD isn't a dying business. It's a $350 billion behemoth. I mean, this is one of the most incredible corporate turnaround stories of our time. And the source thinks there's a real path for them to become a $1 trillion company. And this chip right here,
This is why. The whole bull case pretty much hinges on the MI450 chip. The claim is that this is the product that's going to launch AMD's data center business into the stratosphere. Apparently, demand from big tech is absolutely massive, and the expectation is that this thing is going to seriously boost revenue and profits starting in the second half of 2026. Okay, let's switch gears completely. We're going from silicon chips to makeup. Our fourth company is ELF Beauty, and their success story, according to the source, is all about being incredibly savvy, just super smart, about how they reach a whole new generation of customers. So the source basically breaks down their growth formula into 3 steps. Step 1, they absolutely dominate social marketing. They are masters of TikTok, even Roblox, places their customers live and breathe. Step 2 is a pricing move. Because their stuff is already so affordable, they can make these small, strategic $1 price hikes that don't scare anyone off, but make a huge difference to their bottom line. And step 3, this one's a potential bonus. If some Trump-era tariffs get overruled, it could mean a huge financial win for them. Now, check out these projections, because this is where it gets really interesting. Yeah, the bull case is a massive 38% annual growth rate, but here's the kicker. Even the bear case, we're talking the worst case scenario they modeled, still projects a return that basically matches the S&P 500. So the argument is that the potential upside is huge, and the downside, well, it's not so bad. That's a pretty attractive setup. And that brings us to our final company, number 5, PayPal. Now, the source calls this one a classic hated stock. You know, the kind of company where the story everyone tells about it might be totally, completely different from what the actual numbers are saying. And the thesis really starts right there, with that negative feeling. I mean, let's face it, this is a very hated stock. It's been underperforming for years, and the whole story, the narrative you hear is that it's a business in decline, a fallen giant. But then the source says, okay, forget the story for a second and just look at the numbers. In their latest quarter, the total amount of money moving through their system was up 8%. Their net income, that's their profit by standard accounting rules, was up 24%. Earnings per share, up 32%. And then get this is the real kicker, their adjusted free cash flow. Basically, the cash the business is spitting out, grew by a staggering 48%. These are just not the numbers of a failing business. So you see the disconnect, right? The story is bad, but the numbers look good. The source lays out a potential future where PayPal just keeps using all that cash to buy back its own stock, maybe even gets approval to operate like a bank so it can offer new stuff. And if that happens, the belief is the market will eventually have to notice, potentially pushing the stock to a base case value of somewhere between $132 and $169 a share by 2029. And that really brings us to the big final question, doesn't it? When you look at all 5 of these very different companies, you've got Nike's turnaround, PayPal's bad reputation, there's one theme that ties them all together. Every single one of these investment theses is built on the idea that the story the market is telling right now just doesn't line up with the actual numbers. So it really makes you wonder, in the long run, what's more powerful for an investment? A popular story or some really unpopular numbers?